Alright guys, I'm gonna start with a risk warning. Leverage trading in foreign currency or off-exchange products on margin carries significant risk and may not be suitable for our investors. We advise you to carefully consider whether trading is appropriate for you based on your personal circumstances. You may lose more than you invest. We recommend that you seek independent advice and ensure you fully understand the risk involved before trading. The information on this website is intended as educational in nature, and we do not recommend that you buy or sell any specific financial instrument. All right, with that being said, guys, I do want to let you guys know that there's a lot of information, and I don't know if I should talk about penny stocks or I should talk about options trading. There's two different ways to trade: the big market caps and the penny stocks. I do recommend that if you don't have a lot of money, let's say you can only invest at the time, $200. That's not a lot, but you can make money out of $200. And I do recommend options if you do have a small account. And if you have a bigger account, then maybe trading penny stocks, because there's a lot of money in penny stocks. Just a brief discussion about penny stocks. Penny stocks are basically scams where the CEO of a company will pump the stock so high and people will buy into it, and then they get trapped. It's called a bull trap, and they buy high and it comes down below real fast, and then the stock never is gonna go up again, not that high, because of the same reason that it was just a pump and dump. A lot of the companies, OTC companies, love doing this because they can, and why wouldn't they if they're making money? Let me show you real quick. BPTH. Let me show you real quick. This is a small market cap that I'm talking about, and I want you to see what I mean. This could have been a great play if you played it right. But let me show you how crazy this is. I don't know if you can see right over here, it tells you the low of the price right there. If you can't see it, that's because it says 1.6 right there, guys. Oh man, sorry guys, I don't know why it's not getting it there. A low of $1.6, and this particular stock, I don't know why it's not focusing, went all the way to $73. Now if you had bought this penny stock at $1 a share and sold it for $73 every share, you would have probably be in good money right now. But guess what? That was a pump and dump. Because if we were able to get in here and take profits along the way over here, great for you. But if you bought the stock because it was moving over here and you thought that the stock was gonna keep going higher, it just dumped the next few days. Boom. And over time, it just went down, and now it's at 11.92. So you gotta be very careful. You gotta be very careful with penny stocks. It's a great way to make money, but it's a scam. So I do recommend penny stocks because they're very simple, and it doesn't take a lot to understand penny stocks, especially because you just buy low, sell high, which is not very difficult to do. which is not very difficult to do at all. So, but I'm gonna talk about. I want to talk about option trading. That's where the real money is at. You can make a lot of money out of this. Don't get me wrong. You can just see that how much money you would have made there. But I really want to talk and focus on trading options. So what I want to show you is that what is important on a chart. Let me go to TLT. What is important in a chart to see? Guys. So I'm gonna explain it right over here. So this is the RSI. This is an indicator that I use, and a lot of professional people or hedge funds use it as well. I think the Wall Street in New York, they also use it because it's very, very important. It's called the RSI, Relative Strength Index. So basically, this is a very simple way to understand what is happening in the bigger chart. Now, this is just an indicator. It doesn't mean that you got to do what it says. But most of the time, it gives you an indication of what's the next move. So as you can see right here, the stock, every time the stock hits blue, it pumps up again. It goes to the middle and it goes up. And every time that the stock is in higher highs, is in red, meaning it's about to go low. Boom, and then it goes back up and then down and down, because what's gonna happen next? Up. Once the RSI reaches the level of 70 right over here, guess what is gonna happen? Yeah, you're right. It's probably gonna go down because it respects its history. Remember, guys, history repeats itself, and it's very important for you to understand that. So let's see this. You see, every time that it hits blue, it bounces back up. And how do you know? One of the biggest questions I always get: how do you know when to buy? Well, like I said, I based it on history, because as you can see, this is a 180 day and 4 hours, and this is a 5-minute day and 2 minutes. So this one is gonna be more volatile. What I mean by that it's gonna hit more often the blue, because it's within 2 minutes. Is a 2-minute frame with 5 days. So every time right here you can see it hits blue, it goes to the top. It hits blue, it goes to the top. It hits blue, it goes to the top. Now, this does not always work, guys. This is just an indicator of the things that are oversold. So every time it hits below 20, below 30 over here in the relative strength index, it's a buy. It's a buy. And every time that it reaches over here, you gotta sell it. Now, that's not always the case, like I said. Sometimes the stock will reach lower lows, and that's why it's important to understand that how the company is doing in revenue, and how the company is doing in overall earnings per share, and how many hedge funds are investing. So quickly, of what is most of the basics and most important of this. First of all, I want to tell you that you can buy $50,000 of a stock, and you're not gonna make things smooth. You're not. But it does come down to basic economics, which is supply and demand. We understand what supply and demand is, So we're having a basic understanding of supply and demand. It's important to know where the demand is, because when there's demand, the price of the stock is gonna go up. When demand decreases, it's gonna go low. And as you can see, every time, not every time, but most of the time, right over here, doesn't want to zoom in. There you go. You see, every time that it reaches a higher high right over here, boom, guess what? The RSI is indicating, hey, I'm topping. this means I'm overbought. So it's time to sell. So now they start selling it. There's a sell off. Boom. And guess what? Over here, the blue thing is telling you, hey, I'm oversold now. You gotta buy me. And guess what? It goes up again. Boom. And it goes down and up and down. So basically what I'm trying to say is you don't buy in the middle. You don't buy in the middle. You buy either low to go high, or you borrow the stock and sell it when it's lower. That's what you do. You don't buy in the middle. And that's a problem with a lot of people, that they're not patient enough to wait for the stock to move lower. They don't wait for the stock to move lower. They want to go in because the stock is hitting new highs. Look at this all bull time highs. Boom, it run. Then it comes down. It start running. Boom, it comes down, and then it goes up. It comes down and it goes up. Guess what's gonna happen here? It's gonna probably go down and keep going up. So that is important, guys, to know the relative strength index. However, there's a lot of technical analysis that I will explain in a little bit. Let's see this. Okay, that's one of my favorite ones, though. This is one of my favorite ones too. This three lines that you see here, the yellow, the white, and the blue, they represent the moving averages. They represent the moving averages. And remember, the more history you have, the more solid the line is going to be. The more respectful the line is going to be. So this one right here is called the 200 moving average. This one right here is the 50 moving average. And this one, the yellow one, is the 20 moving average. A lot of institutions use this type of strategy because it's very technical, and like I said, it's very important. I can't trade without those technical analysis. So what about those technical analysis? Well, let me tell you something. Right here, come on. Whenever, this is the best time to buy. Whenever the 200 moving average is above the 20 moving average and the 50 moving average, and there's a reverse about to happen, that's the best time to buy, because you know that the market is about to get a bull. So right now, I'm expecting the 200 moving average to have a reversal. When that happens, the stock is gonna ricochet to the top. I guarantee you. Not because I'm looking at it right now, because I've seen it a lot of times. And when the market is live, obviously, it's hard to predict all these movements, but it's not that difficult. So you can see, boom, right here, there's a reversal. How do I know there's a reversal right here? Well, you can see all the three lines having a reversal right here. Boom. So now the 20 moving average is leading the way. The 15 moving average is gonna act like a support, and the 200 moving average is gonna act like support. So then the rally starts. Boom, 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 boom. The stock goes from 130 all the way to 142. Wow. And then you can see right here that the short sellers, which is this one, this is the amount of volume that is being shared, guys. So whenever the green candle is bigger than the red candle, that means it's gonna go higher. Whenever it's the opposite, that means it's gonna go lower. But you have to understand something about this. Whenever there's a drop like that red, I can guarantee you almost that there's gonna be a little bit of a pullback. And when the pullback happens, it breaks above the 20 moving average. There is a highly chance that it's gonna go, they might go to the 50 moving average and it bounce from there. Sometimes when you start seeing these two lines to cross again, that means there's gonna be a reversal. Yes, that means it's gonna go down, guys. There you go, you're learning. Woo! There you go. So right there, boom, it keeps going up. It respected the 20 moving average. It bounced from the 20 moving average back up, and it keeps going up. Now right here, it breaks resistance again. I mean support. Remember, guys, the 20 moving average, the 50 and the 200, they act like support. Now it broke. Boom. Now it bounced off. It bounced off the 50 moving average, but it broke the 20 moving average. You gotta be careful now. That means that the bull is losing its strength, but it bounced a little bit back, and you gotta check out the volume too. It bounced back, but guess what? The red candle is bigger than the green. So guess what's gonna happen? It's gonna keep going lower. And there you have the reversal. Boom. So I wouldn't be surprised if by Monday morning the stock goes into a pullback, back to maybe half. I wouldn't be surprised. But this is the one that I made my $700 off, TLT. And let me show you how options work. This is a platform called TD Ameritrade, or Thinkorswim platform, that is given by TD Ameritrade. So those are my secrets, guys. It really is. It really is, man. I'm sharing a lot of information. But it's alright. It's alright. So guys, remember, this is very important. Volume is very important. Moving averages, very important, and relative strength index is very important. But I'm gonna show you something that let's go Tesla, because it's a bad company. Like I said, it's not always gonna be respectful. You see, and most of the stocks are gonna be always the same. So from here, you can see that the stock was blue, it went up to red. It went up, and then when it reached red, it kind of had a pullback. It went up, trying to push for higher highs. It came down, trying to push for higher highs. So when you see 1, 2, 3, and then 4 rejections above this, it's time to sell. And guess what? There was a sell-off. Boom. So now they try to go back. But look at this pattern. You don't even have to look at the chart over here. Look at this pattern. It reached higher highs all this times, try to break that resistance, and then when it dropped, it never went back up. So meaning the resistance is no longer at 70. The resistance is now at 60. You can see that 1, 2, 3, 4, 5. Right? So why would you buy a stock right here? You can't do that. Why? Even though it's gonna be in blue, it's probably gonna hit a lower low. What I mean by that is that every time that it goes up, it sold some more off. Like you see right here, boom. And the company itself is not doing good. So you might be thinking, oh, let me buy here. That way it goes to 60 again. Well, why is this stock not going up? Why is there a major resistance here? And that's where you gotta go and look for the revenue and all this other stuff that is important as far as why the company is doing good or bad. But let me show you the real thing, the real deal, the options. This is just very basic and is very fast information, and I hope I didn't confuse you guys. Really, shoot me a message if you're not understanding. If maybe I don't explain myself right. I don't know. I'm not a teacher, so I just trade the market. Let's go, baby. So I want to show you real quick. This is TD Ameritrade Thinkorswim, and I want to let you know, guys, know that per contract and this thing is crazy, So I think it's $10 per contract, so it's very expensive. That's the reason why I use Robinhood. Although this is it's my personal platform. This is where I have a more different different money, whatever. And my Robinhood is where I play more with it. But this is actually my personal platform where I don't really share anything information as far as that. So let me go to Robinhood. Robinhood. Oh, really, Robinhood? This is it. This is Robinhood. Okay, so I love this company. I like it a lot. Zoe's. So, man, I can say it's buy the dip, man. This is a great company. Great company. But, well, I'm not a financial advisor, so don't listen to me. Anyways, let me show you guys what is an option call. So, let's say TLT. Boom, there it is. Ooh, iShares 20-year Treasury Bond ETF. So this is how I made my $700 on Friday, guys. So I started, the market was red all day, man, but my baby over here, ETF bonds, were green. Hell yeah. So how do I know that the stock is gonna do this? Well, usually when the stock market is green, this is red, and when the stock market is red, this is green. So you have to know what to do in the market. Anyways, guys, so the biggest question is, okay, Danny, you bought here. Let me see. I bought around 9:40 a.m. Eastern time. I bought about right here the option, okay, and I sold it right. I didn't sell it here. I wish I had. I probably sold it around this area, around this time, at around that time. I'm not too sure, but you might be asking, well, how did you do $700? How did you make $700 if the stock only moved from 143 to the high of 146? How did you do that, Danny? You're lying to us. You're a liar. Well, that's why I love doing options, because you make contracts. So I bet against some market makers that the stock was gonna reach a high of $146. And if that stock reaches 146 or 145, then I'm in the money and I can sell my contract for more money. So the thing is, like, well, how did you make $700? This thing just moved $2-3. Well, here it is, guys. This is a secret. You go to Trade TLT options. Options, guys, are contracts. So basically what this is a contract that you're making with the market makers, and the strike price is the price it's trading at. The break-even price is when you break even from your trade, and it tells you the percentage to break even and the chance of the change of how much the percent is. So so TLT costs. So at the time, I bought it at. It's probably in the money already. Oh snap! Give me a second, guys. So the share price is 146, right? But at the time I got it was at 143. So, oh man, how do I lower this? no, it's up. So since the market moved up on this particular stock, I bought the stocks that was $143 prior to this. I wish I had a screenshot of it. I did posted it though on Facebook. Where this particular, let's just talk about this strike price, is 148, and you're gonna pay 0.72 cents per contract, guys. So why are you gonna pay 148 when you can pay 0.2072 for one contract? Now you gotta understand that 0.72 is a multiplier by 100 because they're giving you 100 shares under of this stock. It's not, you're not buying one share of $148. You're not buying one. You're buying 100 shares, 100 at $148. So basically, they give you leverage. You don't have what is it? Whatever the number it is to buy that. Let's say you just have $200. How in the world are you gonna buy a 148? You want to buy 3 shares of that? It's impossible because your cap is $200, and you want to buy 2. You don't have enough money. But if you do an option contract, you do, because there's only 72 cents. So the way you make money is that if you predict that the share price is gonna go up to 148, that's a 247% return, guys. So this is how you make the money right here. You don't need big capital. All you need is the right direction. But there's a lot of stuff that involve option trading. It's not just the underlying stock. There's a lot of stuff that go into place, and you cannot actually this is gonna be the expiration day. So meaning, I think that by January 17, 2020, the stock is gonna be worth $148. Boom. But you see, you're gonna pay a bigger premium because you're giving yourself more time for the stock to reach that level. Now, this is the way you make money, guys. This is the way you make money. Okay, so let's go to TD Ameritrade again. Let's go to, I don't know, a stock that doesn't move a lot. Let's say, I don't know, Home Depot. I like Home Depot. So the way you make money out of these contracts, this is the other play that I made, that I got us $700 on Thursday, $700, and on Friday from the other play another $700. So how do I do that? Well, guess what? Right here, guys. Same information, guys. I think I invested like $300 and made a profit of $700, something like that. Well, you can see right here that the stock was on the bottom and it had reached lower lows, and this is a signal to buy, especially before earnings. Earnings is the season where they tell you about how the quarter was. And I do believe that Home Depot is doing great as a company, because there's always houses being built everywhere, you know. So we have strong customers, consumers, and there's the demand. Like I said, guys, it comes back to supply and demand. So there's demand for houses. Guess what? Home Depot is the place to be. So I bet I in this stock. And I bet that the stock was gonna go from 204 all the way to 210. That was my bet. The stock ricocheted all the way to 220. Wow, that's over I want to say 300-400% return, guys. Boom, boom. and guess what? There's a sell-off. You know why? Well, the market's been the trade war with China and stuff, but that's not the reason. No, that's one of the reasons why it's going back to lower lows. And another one is because it reached a higher highs that it hadn't reached in over a long time. So you can see that you can expect that there's a sell-off. That's why you don't stick to it. I don't invest, guys. Don't ever invest. Don't ever invest. I don't recommend investing. You day trade. Because the economy goes up and down, and if you're not smart about it, let's say you didn't want to risk whatever. So you say, you know what? Home Depot beat earnings. They're doing excellent. It's a great company, and Home Depot gives you the chance, or the stock market gives you the chance to buy here, and from 217 it went all the way to 222. That's about 30-40% return, which is good. But then the next day it starts selling off, and now you're stuck. Not only you lost all your gains, but you lost your money that you put in right there, boom, because it reached lowers. So that's what I'm saying, guys. It's not about keeping the stock and getting married to it. You can't treat it like that. The stock market is a dirty place, man, and if you don't get it going, it's gonna eat you up. It's gonna take your gains away. So you gotta act fast and be disciplined about it. So there you go, boom. So that's why it's important. But that's the way to do it. The best way to do this, guys, is to trade earnings. If the stock, I don't know why a lot of people, I guess people are greedy, but if the stock does not move $10-15, and it never in the past 5 years has it done that, don't buy out of the money. Let's say, for instance, Home Depot has never made a $10 move in history, in all this time that you've seen, the last 5 years. It has never done a 5-year move, a $5 move or $10 move. Why would you bet that the stock is going higher? There's no reason why. There's just greedy. It's just mind. It's like your mind thinking, oh yeah, it's gonna go, and it never does. You know why? Because it has never happened. So don't be tricked into buying cheap stocks. Don't be tricked into buying cheap option trades. What I mean by that, let me explain. Look, right now the stock is trading at 146, TLT stock. I'm not gonna say nothing, but I would buy it, but I don't recommend you to buy it because I can't say that. Anyways, right now the premium for this is $4.28. Okay, remember it's a multiplier by 100, so it's gonna be $428. But you get 100 shares of it, not only one, but 100 shares. So let's say the stock this goes up. Your premium is gonna be worth 6.28 or 6 or 7 or even 8 or even 9 or even 10, 11, 12, 13. It has no limit, basically, guys, because there's no limit to the upside. But you can see that the share price is 146, so the probability of getting to 147 is very high. That's why the premium is so expensive. For $420 is kind of expensive, but because you're almost in the money right here. Now, if you go out of the money, you start getting cheaper, but you can see that the return starts getting bigger, 34, 37, 36, 37, 37, and as you go more up, 38 and more up, and you start seeing more percentage return. So people get into the idea that the cheaper the price is, and what if it does move to 167? What if I do buy the stock at 148 and the stock does go all the way to 165 or 1 whatever, and I bought it for 40 cents Wow, it's a return of 42%. But like the likelihood of that happening is very low, guys. So don't get greedy into believing that the further out the money, the more money you're gonna make. No, guys, you gotta be reasonable, and that's what I'm saying. If the stock has never moved $5, why are you betting that the stock is gonna move? What makes your thought special? Nothing. The market doesn't care. I don't care. So, guys, shoot me a message if you're interested in knowing more. This is just a very brief. There's so much to learn, guys. Well, have a blessed day. Take care.